This is TreppWire Week in Review for the week ending October 27th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week was another rough one for the markets. Tech stocks took the brunt of the losses after weak cloud computing numbers from Alphabet led to a 10% drop in shares. Jamie Dimon had some words for the central banks, saying they have been dead wrong on economic forecasts. And today's GDP number was much stronger than what was forecast. But the reaction in Treasury markets was equally surprising, with yields declining. With that in mind, Lonnie, how do we think the recent economic data will influence the Fed's upcoming rate decision?
Yeah, I think there's a lot of interesting data for the Fed to take into consideration. You have GDP that came in really hot, higher than analyst expectations, 4.9% against an expectation of 4.3%. The labor market is still really tight, but you're starting to see consumer spending or the capacity for consumer spending to wane a little bit. And I think the GDP numbers are a little misleading in the sense that they were driven predominantly by consumer spending. And that didn't take into account, given it's a look back, of the impacts of the student loan moratorium expiring, and maybe some of the newer data that shows consumer spending is going to start waning as savings, household savings has been depleted. So I think for the Fed, this probably buys them a little cover to keep rates where they are and not have to push the envelope here, not to mention the other global unrest that we have. A lot of plates spinning, a lot of moving parts in the market right now. It is interesting, with the GDP coming in as hot as it did, the Treasury markets reacted the way that they did. But if I were betting at this point, I think this gives the Fed enough cover to say we're going to hold tight. And I think it's interesting. If they raise it another 25 basis points, I don't know that by definition moves the needle at this point, one way or the other. And so I think they've kind of realized at this point, an extra 25 basis points probably doesn't have a seismic shift in market reaction or how people move on beyond that. And so if that's the case, why not just hold steady, let the markets feel the effects of the significant increases they've raised over the last 15, 18 months, and then go from there. So it'll be interesting to hear Stephen's point. I mean, it's a lot of stuff for Jamie Dimon. I kind of find it funny when he's coming out against analyst and economic forecast, because he's been on record multiple times. I think at one point about 12 months ago, he was calling for an economic hurricane, and that hasn't happened either. So, it's kind of interesting for him to take such a staunch position at this point, but interested to hear what Stephen has to say around the market, just other topics of the week.
Sure. When I saw the GDP number drop and heard the reaction in the Treasury market, the Treasury yields dropped. And with a GDP beat that large, I would have expected yields to increase. But we've already pushed close to 5%. So really the market has been pricing in this higher for longer, more resilient economy, and ultimately done a lot of the Fed's work for them in tightening financial conditions. And this is a really interesting data point here. The CME Group FedWatch tool that takes into account I like to call it the bets that traders are making on what will happen in the future with Fed funds and treasuries and whatnot. Well, those probabilities show a 99.3% chance the Fed will hold rates steady next Wednesday at their FOMC meeting, November 1st. What's funny, though, is that 0.7% remainder isn't actually for them to raise rates by a quarter point. It's actually to drop them by a quarter point. This is so drastically different than anything we've seen over the last, call it 8 months or so, when it's just been on the march higher and kind of wondering how high will they go. And getting back to the reaction function in the Treasury markets today, with yields dropping with such a strong GDP print, the opposite of what we would have expected, I was trying to figure out, were we reading the fringes of the tea leaves here, or trying to read discarded tea leaves in a trash can? Is this garbage just toss away and something else is driving numbers, or is it something finer behind the scenes? And the only thing that has really made sense to me is that the GDP sales number came in really far below forecast. It came in at 3.5%. So that component was weaker. And then the core PCE prices for Q3 came in 1/10 of a point lower. So it came in at 2.4% versus the expectation of 2.5. So ahead of tomorrow's PCE, inflation index. So perhaps there's some expectation that PCE will continue to ease. There's some weakness on the horizon, like you mentioned, Lonnie, and that we shouldn't really read too much into this strong headline GDP number as saying, we're going to just blast through 5%. I think the Treasury market is kind of consolidated around that 5% level. Curve inversion is now only 20 basis points. So I think for real estate markets, in a way, that's good that we have a narrower trading range on treasuries, but this is significantly higher than where we were at, 6 weeks ago.
If you want some additional news to chew on, how about this for some stats? The U.S. wraps up its fiscal year budget deficit near 1.7 trillion, which is up 23%. So we round up the fiscal in September. I guess the good news is there were some in the market that thought the shortfall could exceed $2 trillion, and it ended up only at 1.695 trillion, up about 320 billion year over year. And it comes the same week as Congress is asked to allocate 105 billion to national security priorities. So I'm not good at math, but that doesn't seem like a long-term viable solution for us. And so it'll be interesting to see what your take is around deficit numbers at that scale.
It's interesting you bring this up because on the plus side, we now have a Speaker of the House, finally, after, how many weeks of debacle. But this budget deficit and what the GOP has been posturing towards makes me wonder, will we see a government shutdown here? What was it in November is when this kind of all sets up? It's entirely possible, because this budget deficit can be incredibly damaging. It's very costly for the U.S. to fund debt at these interest rate levels. So I don't love it. We're not, I would say, at a tipping point yet where I could see Moody's downgrading us after all of that GOP dysfunction, and if we do get some posturing around government shutdown in November. And I think that's one of those events that could push us well above that 5% level and break through that resistance range.
Yeah, it'll be interesting. The new speaker, I think, I haven't seen what the odds are, but I would assume that it increases in likelihood that there's a government shutdown, or at least posturing around it. If you listen to Barry Sternlicht this week, he was on a couple of shows and he was saying just the cost to service the debt for the government is going to force them to lower rates. And so he definitely has been pushing that thesis for some time. In the open, Haley talked a little bit about some of the tech stocks and the downward trend and sell-off that they saw this week. Alphabet was down 10%, which is, just for some quantification of that, the size market cap of Nike. So imagine coming out and, having not terrible earnings results and the market reacting in a way that you lose the value of a Nike in a couple of days. And so it's just interesting. And, if you look at the last couple of years, when the market was really hot, tech stocks were a driving force with a lot of that. And now we're starting to see a lot of cooling around tech stocks in general. We've obviously talked at length on the podcast about downsizing the real estate portfolios, taking charge-offs to get out of leases, et cetera, et cetera. So not great news for the tech folks this week with Alphabet and Meta, seeing a downturn.
And I don't want to get this one wrong, but from what I recall hearing, part of that sell-off was related to the weakness they had in cloud computing sales. So it's really been amazing to me to see, just how magnified the AI and cloud computing push has been over the last few quarters, and what it means for tech earnings reactions. And then turning to real estate, that tells you just how critically important the data center industrial side of things will continue to be over the next few years. So even though we're at just incredibly tight vacancy rates, around 2%, I think is what I see on the whole industrial sector. At least for the data center side, that strength should continue.
Yeah, so we actually had an email from a listener today that talked about data centers and why we hadn't gotten into a deep dive or done some analysis on that. So I think with your comments today, Stephen, you have signed yourself up to find some data center data. And we'll talk about that maybe next week or a week after.
I think I did.
So after we talk through all the negatives and the uncertainty and volatility in the markets, it can be hard to find silver linings, but in the CRE markets, we actually have seen some deals getting done and some positive news for the heavily watched mall and hotel spaces.
Yeah, so I think what you call it there, silver lining, is what this is. The reality is issuance is down significantly year over year. Deal volume is down, transaction volume down, but deals are still happening. Issuance is still happening. Buyers and sellers at some level are still working deals out. So, some good news and maybe an overarching, neutral news market, or maybe slightly negative. There's been several new large malls that have had new loans announced over the last few days, which really runs counter to the narrative that capital is not available in the markets. It's constrained, but this just shows that capital is available for good assets, even in a sector that's been challenged for several years. So as an example, there was one announced this week, a new 5-year, $235 million loan for the mall at Columbia. It's 1.2 million square foot super regional mall in Maryland. If you transition over to the hotel space, there was a new $410 million loan on 2 hotels in South Florida. That one's maybe not as surprising given the strength of and resiliency of the South Florida market over the last year or so. Because Commercial Observer reported on this one that a 4-year, 8.7% fixed rate loan was made on the Four Seasons Resort. This was at Surf Club and Surfside, and the Four Seasons Resort Palm Beach. That loan for those properties was done at 52% LTV. So, high on the interest rate side, but it seems like there was still an appetite from the borrower's perspective to get that done. And then one additional hotel loan in Florida was a $750 million JW Marriott and Ritz-Carlton hotels in Orlando. Had a 2-1-1 floating rate. Its original 2-year term with 2 12-month extension options, and it was done at an LTV of 62%. So even though the markets are a little bit constrained from a capital perspective, between those hotel deals, you're looking at about $1.2 billion in loan origination at LTVs that are probably not too distant from where they were a couple of years ago. Obviously more conservative, but for the hotel sector, that 60-65% LTV was probably what you were getting in a really strong market. So now at 52 to 62% for me, Stephen, that doesn't raise any red flags or challenging considerations based on where we're at given the cycle.
No, and to me, so long as the underwritten appraised value was fairly well done, right? This tells you how much price discovery has happened over the last 6 months. And this is ultimately what we were hoping to see entering the very back part of the year, is that you'd have enough seller capitulation on price that deals would start to get done. Distressed debt would kind of get selectively released into the market. And this trickle of deal flow would ultimately build confidence around the price discovery process. And so long as these are clean deals, minimal hair, lots of equity in them, this is a good sign, right? It tells you that we're in that part of the market where creativity can be rewarded, so long as you do have capital.
So Haley actually posted this out today on Twitter, and I think for those that have been listening the last few weeks, we've talked about a new daily publication that we're going to be putting out, and I think this is a pretty good insider peek at what maybe the market rundown or intro may be for those publications. So we're going to be teasing these out over the next couple of weeks. So this is a sneak peek of our daily email rundown that we're going to be putting out every day. And so more to come on this. Check it out on Twitter. You should be able to find it under @TreppWire. And you'll see some of these things coming out over the next couple of weeks before we do a full launch.
All right, so let's get into our property type segment, and we have some office green shoots to start with.
First up, we have a trading alert. It's a new lease for Houston office. Back in February, we noted that the second largest tenant behind the then $41.6 million 8 West Center loan would be vacating. Now it seems a new lease has been signed that will backfill a big chunk of that space. This property is a 227,000 square foot office in Houston, Texas. Almost all the space is taken by 2 tenants. Helix Energy Solutions has 52.25% of the space on a lease that ends in 2025. And Cameron International Corp has the majority of the remaining space, 47%, on a lease that ends next month. So servicer watch list notes from earlier this year noted that Cameron would be vacating. Now, Commercial Property Executive reports that the Ogden Engineering Company has signed on for almost 72,000 square feet of the property. Up next, we have a hedge fund to move New York City offices, has implications for 2 CMBS loans. According to Commercial Observer, hedge fund Davidson Kempner will be moving its offices from 520 Madison to 9 West 57th Street. In the process, the firm will be increasing its square footage. So this is great because a lot of times we've been seeing consolidation or downsizing. They're currently at 520 Madison Avenue, where the firm has about 71,000 square feet. Jefferies is the top tenant at that address with almost 44% of the space on a lease that ends in 2029. So Davidson Kempner is the third largest tenant with 6.9% of the space on a lease that ends in 2025. This property backs a $675 million loan, and the property contains a little over 1 million square feet. And over the first half of this year, the loan posted a debt coverage ratio of 2.2% with occupancy at 99%. The 9 West 57th Street property backs a $1.2 billion CMBS deal. The collateral is nearly 1.7 million square feet. Over the first half of this year, that loan posted a debt coverage ratio of 2.85 when the occupancy was 76%.
Yeah, I think both of those are really great stories. And, you know, since you're helping us out today, pinch hitting for Manus, Stephen, it's great that you get to do the green shoots and I'll get stuck with the crabgrass. And I wanted to take just a quick second and give a shout out to Manus. The reason he's not on the podcast today is because I was supposed to be in Charleston doing an event today and was going to actually miss the podcast. And my flight out last night was canceled due to storms. And so Manus, being the team player that he is, said he wouldn't mind driving 4 hours each way from his home in South Carolina to Charleston and cover the conference. So kudos to Manus, and I really appreciate him stepping up and helping us out. Likewise for Stephen for pinch hitting and coming in and really helping the podcast keep its continuity. So with that, I'll jump into some crabgrass stories, and we have a few. Microsoft has announced they're going to vacate 50,000 square feet of additional office space in San Francisco. This is on top of other previously announced lease terminations or decisions to vacate, however you want to phrase that. And this is really indicative of just the tech exodus that's continued in San Francisco due to quality of life issues. And I think the term doom loop is really, starting to play itself out in that market. It's not limited, though, the negative or crabgrass to San Francisco. We actually talked about a story in Minneapolis, St. Paul area recently, as about a year ago that we reported on this on the podcast, but 13625 and 13675 Technology Drive, which is in Eden Prairie, Minnesota, has made available for lease a large portion of a single tenant building. The collateral is a 473,000 square foot office. It was built in 2001, renovated in 2016. United Healthcare is the sole tenant in the building. I think it operates under a subsidiary called Optum. And we pointed out in 2022 that Optum had not revealed whether it was going to renew the lease that was expiring in that building. And according to servicer commentary this month, they've now said that they are not planning to renew and are going to vacate in December. What's interesting on this one is Virtus, which is the owner, they paid about $52 million for the campus in 2020, and the loan matures in 2030. And so now they're sitting on about 473,000 square foot of space that they're going to have to backfill with a tenant. Again, on the silver lining theme, if you're looking for some here, the servicer data also indicates that the loan does have about 4.7 million in reserves. So there shouldn't be an immediate lack of ability to cover debt service. And there are some funds set aside for re-tenanting the space. But it'll be interesting to see. That market has had some really challenging couple of years. And so we'll see if they're able to backfill that space. The next story here is a New Jersey office portfolio that went out to market. This is the National Business Park loan. The bad news here is that the offers came in below the current debt balance. So there's no appraisal reduction in place. The value of the collateral has not been adjusted since securitization. However, there was a broker retained to try to sell the property, and the current bids from the market came in below the loan balance. And so it doesn't disclose what those offers were, but we know the loan balance was $48.2 million. And so it'll be interesting to see what happens here. The biggest property, if you go by allocated loan balance, is 4 Research Way, which has about 30% of the allocation. of the $48 million total loan balance. SES Americom is the top tenant at that address, which has about 54% of the space on a lease that ends in December. According to the servicer commentary, they're going to be vacating the space. They're the second largest tenant across all of the properties in the portfolio. Consists of a couple of other named tenants, Drinker, Biddle. Biddle, as an example, had a lease that ended in March of 2023, although it did extend the lease until 2028, according to most recent servicer commentary. So, this is just another one. Stephen mentioned earlier about capitulation and price discovery. This is one that's not good for the home team if you're associated with a national business park loan.
I guess if I'm stepping back from these stories and thinking about, what does this mean for what's to come over the next 12 months? We know there's a ton of lease expirations happening in 24 and 25, and absent, some really dramatic changes to the landscape. Well, I just think we're going to continue to see this grind lower. That, we've talked about this many times. What is stabilized occupancy going to look like, 3-5 years from now? And we're still a ways off from finding that. So, over the next 18 months, it's going to be perhaps a bit painful at times with how much crabgrass I expect we'll be seeing from downsizing, relocating, or just the continued lease churn. Yeah, it's still seems like we have a good ways to go here.
Yeah, I would agree. It'll be interesting to see on that particular deal, what does the lender decide to do there? I mean, are they going to just take the highest bid and take the loss? Are they going to hold out and try to service, the properties and backfill them to achieve a better outcome at some point in the future? Those are the questions I just don't think anyone has a solid answer because of the points you bring up with stabilized occupancy, cap rates, and other things. No one really knows what that looks like today. So 2 more crabgrass stories in the office sector. There was a big lease termination in San Francisco. So this is our second San Francisco crabgrass story today. This one comes from the San Francisco Business Times. Sarah Clearman. They reported that Dropbox will be paying $79 million to terminate a 165,000 square foot lease. The piece notes that Dropbox has listed the majority of the space for sublease, and this property backs a $600 million loan called the Exchange, which supports the single asset. The Dropbox lease was slated to run until 2033. So as we talked about some of the tech woes earlier, I mean, that's no small chump change, $79 million to terminate the lease. And then one last crabgrass story here in New York. New York office property sells for about 50% discount when compared to its 2017 value. So the 7th floor, 19,000 square foot office, which is located on Manhattan's west side, has sold for about $19.5 million, just about $1,000 a square foot. While if you're not from New York, that sounds impressive. The property, which is located at 14 East 52nd Street, sold in 2017 for $36 million. So the latest comp represents 54% discount. The sale, represented about $1,900 a square foot back in 2017. The news comes from New York Business Journal that the property was once sought after by Harry Macklowe, who had an eye on creating an assemblage and creating another tower on Billionaires Row. The sale to Macklowe in 2019 fell through, however. So, this is one where you don't know what the motivations were on the purchase in 17. Maybe there was some speculation there. They're going to be able to flip this. It didn't turn out. But if you just look at the raw data, the discount's actually consistent with some other recent Manhattan office sales. So earlier this month, Sovereign Partners agreed to acquire 100 through 104 Fifth Avenue from Clarion for nearly a 50% discount to its 2013 sales price. So, not great news for a couple of office sales there in the New York City metro. And then last one for the office sector, we have a mixed green here. Burns and McDonnell moves to a new Inglewood, Colorado office, which has implications for 2 current CMBS loans. Burns and McDonnell has opened a new Inglewood, Colorado office. In the process, they've expanded their square footage, so another green shoot from that perspective, just like Stephen talked about earlier. In this case, they increased their square footage by about a third. The announcement has implications, as we mentioned, for 2 CMBS loans. On the negative side, it appears that the firm's going to vacate their current space at Meridian 1 Colorado, which is located at 9785 Maroon Circle in Inglewood. And that property backs a $16.2 million CMBS loan, which is part of a BBCMS 2020 deal. That deal is also part of CMBX 14. Burns and McDonnell was a top tenant at 140,000 square foot. B&M was a top tenant at that building, which was comprised of about 140,000 square foot. And they occupied about 67.5% of the space. That lease was slated to end in June of 23, was spent to special servicing the following month, and payments on the loan ceased. So this loan is in trouble. They're now working through the foreclosure process with the borrower, stating it will proceed with a consensual foreclosure. Burns and McDonnell has taken about 125,000 square foot of space at 9191 South Jamaica in Inglewood. So this property is one of three that backs a $78.2 million loan. Mixed green, just like we've seen in the office sector, where you have a tenant that expands space, goes to a new building, great for one owner, unfortunately vacates and makes bad news for the other. And in this case, it's doubly bad because that loan was already struggling, and now one of their largest tenants is vacating. So hate to end on a crabgrass story, so we'll focus on the silver lining on the new lease and the expansion, but bad news for the folks at Meridian One Colorado.
Spinoso Real Estate Group's industry-leading mall investment and operating platform is positioned to capitalize on a historic opportunity in the retail real estate market. With a team of seasoned experts, they offer a comprehensive and proprietary platform that identifies unique mall investment opportunities, conducts meticulous due diligence, and implements winning strategies. SREG's proven track record of executing value-add strategies includes operating over 80 malls, 72 million square feet. The time to invest and capitalize in malls is now. Partner with Spinoso to maximize on a historic opportunity. For more info, visit spinosoreg.com. Okay, so let's turn to our retail segment.
So first, we have a trading alert for a 2013 mall loan that was extended. Last month, we reported that Unibail Rodamco Westfield has sold the property behind the $186.9 million Valencia Town Center loan for $199 million. The buyer is said to be Dallas-based Centennial. The expectation was that the loan would be assumed and modified, but there were no details last month. This month, new servicer data revealed the new terms. The collateral is a 1.1 million square foot mall in Valencia, California. The property was built in 1992 and renovated in 2010. The loan did not pay off as scheduled in January 2023, so the new term pushes the maturity date out to September 2027. The Trepp cash flow model has been updated, and this note makes up about 70.6% of the collateral behind a 2013 CMBS deal. A partial repayment was also made this month. In 2022, the debt coverage ratio based on net cash flow was 2.07 when the occupancy was 92%. Those numbers fell to 0.48 in Q1 23 when the occupancy was 73%. So great that this property transacted, and this modification pushing it out to 2027 shows you just how aggressive some special servicers are getting in modifying the loan term, because it's not just survive until 2025, it's survived through. So this one survived well past 2025. Another green trading alert we have is a big 2018 retail loan could pay off next month. According to new servicer watchlist notes for the $314.3 million site portfolio loan, the note could pay off next month. The notes indicate that the borrower has submitted a request for prepayment targeting November 6, 2023. The loan matures next April. The loan is backed by 10 retail properties totaling 3.4 million square feet. The portfolio is spread across 9 states. For the first half of 2023, the loan posted a debt coverage ratio based on net cash flow of 2.45 when the occupancy was 95%. The majority of the debt is in a SASB deal, a 2018 SASB deal, CSMC 2018 site. Some of the lower rated classes in that deal have marked handles in the $93 to $96 ranges. So a near-term payoff at par would be an absolutely fantastic outcome for those bonds that are getting back 100 cents in the dollar if you're paying 93 to 96, say last month or month before last, before these notes came in.
Yeah, that site portfolio is really interesting, Stephen, because their debt service coverage is so strong and their occupancy is so strong. So I don't have it pulled up in front of me, but I'm pretty sure of those 10 properties, they're like your run-of-the-mill Ross, TJ Maxx, Marshalls type of tenant composition, which we know have done really, really well through and post-COVID. So it's great to see. I mean, I've been saying in a couple of speaking events I've had over the last couple of weeks that, you know, we really transitioned from retail apocalypse to retail renaissance. And I think this is just another strong indication of that with a very large, $300 million type of loan with super great retention in terms of occupancy and performance metrics on the debt service.
Yeah. One detail I forgot to mention at the very end was that this note can be prepaid freely. So without having it pulled up in front of me, my best guess is that this must have had an open prepayment period of at least 6 months. So if it was due to mature next April, November would have been the very beginning of that 6-month freely prepayable window.
And we have some hotel news this week. A Houston hotel that's under contract, and then I think we have some hotel comps across the country.
Yeah, so we need to maybe go back to the broker start your engine on the comps, Haley. I don't know if we've done that in a while, but the CMBX 8, there's an REO hotel in Houston that's under contract, and this one is interesting in the sense that there was a business plan in place. So this property backs a $71.6 million loan. It's the Hilton Houston Post Oak asset. And there was as I mentioned, a business plan in place with an anticipated sale to occur in 2025. But here we are in October of 23, and it looks like they're maybe moving forward a little bit quicker than what they had thought. So the loan before it went REO had not seen a payment since April of 2020, and the asset's been with the special servicer since May of 2020. The hotel was originally valued in 2014 at 126 million and some change, was later lowered to 57 million back in 2020. But post-COVID and the initial shock, it's had its appraised value raised several times since. Still nothing close to what it was at origination, with the most recent appraisal coming in at about 69 million. The asset does sit in 2 CMBS deals. There's a $40 million piece, which is about 5% of a 2014 JPM deal. And then there's a $31 million slice that represents just over 3% of a JPM 2014 deal as well. So both C24 and C25. And both of those, as we mentioned, are part of CMBX 8. When the loan was originally underwritten, had debt service coverage at 1.97x and was really timely in its origination, given that it was underwritten a year before the oil prices began to plunge. Debt service coverage was 2.46 in 2015. That's when the loan was still in its interest-only period. But if you look at the financials, it never reached above 1.53x after that. And in 2019, debt service was already down to 1.17. Then you had Corona and everything that came in and decimated this hotel. Debt service in 2020 was 0.06 and 0.30 in 2021. So this was one of those that was already showing signs of deterioration and decline pre-COVID, never recovered, and looks like it's going to be transacted at a very favorable price for a buyer that hopefully can come in and reposition the asset. In terms of the hotel comps, we'll just run through these quickly. We have a San Francisco hotel comp. This is for the Pebblebrook Hotel Trust, which sold the Hotel Zoe Fisherman's Wharf for almost $310,000 per key. This is a 221 key property located at 425 North Point Street. It traded for $68.5 million. In the firm's press release, it noted that the sale reflects 25 times EBITDA multiple and a 3.2 cap rate on current NOI. So the cap rate assumes a full capital reserve of 4% for total hotel revenue. And the property's NOI for the trailing 12 months ending September of this year was 2.2 million. As a comp, though, these numbers are a little bit of a disappointment, but par for the course when looking at San Francisco real estate, holistically for 2023. If you look for a comparable property, which is a Sheraton's Fisherman's Wharf, which sold in 2019, it traded at about $510,000 per key. So pretty significant haircut on a very similar property in today's current San Francisco hotel market. And that cap rate, if you look at that just on its own, Stephen, at 3.2, that would maybe raise some eyebrows. I think it's just because you're at such a non-stabilized NOI is what's getting you there. Then Boston hotel sale. Another Boston hotel sold for nearly $900,000 per key. The Whitney Hotel Boston recently closed at $877,000 per key. This is a 65-room hotel located at 170 Charles Street. The Agiria Group acquired the asset for $57 million, And there's a full write-up on this transaction in the Beacon Hill Times. And then last lodging comp that we have is not really a comp because it hasn't transacted yet, but it's indicative of maybe a transaction that's on the horizon. So we're going to put this in the not right now category, which is maybe something new that we're going to start running out. And in this example, Choice Hotels International had made a bid for Wyndham Hotels and Resorts. Wyndham rejected the offer, calling it underwhelming. The firm operates about 9,000 hotels. So we'll see if there's more to come from Choice in that acquisition play, or if Wyndham's going to be able to stave them off.
Yeah, it's really interesting to see that potential consolidation going on in the hotel sector. It just kind of tells you how much pressure there is right now to try and gain scale, grow your brands, and compete with, what have been some of the monster flags out there. So we have a green shoot in student housing. Student quarters paid $181 million for Here Atlanta. The property is a 350 unit student housing property at 699 Spring Street Northwest. The sale represents almost $520,000 per unit. The seller was CA Ventures. That story comes from Savannah Ciccarella of the Atlanta Business Chronicle.
Yeah, so we finally, just some insider baseball here, we've had this story on our list for a couple of weeks now, and we've been running long on time. And so I'm thankful that Haley got us to a point where we could share the green shoot student quarters comp with our listeners, get a little student housing checked off.
And then something else that our listeners will really appreciate is a few stories for industrial.
Yeah, so we're going to hit on two stories for industrial today. So the first one comes from Gail Kalinowski from the Commercial Property Executive. Blue Ridge Industrial, which is a Dallas-based real estate private equity firm, has acquired a 28 property light industrial portfolio. The portfolio consists of about 1.4 million square foot of space in North Carolina's Triad region. We've talked, fairly extensively about that area with some other asset classes over the last year or so. This is an affiliate of Dogwood Industrial Properties, is the previous owner who sold the assets for $105 million. So you divide it out, this comes out to about $75 per square foot. Great comp for that marketplace, and hopefully a good buy for the folks at Blue Ridge Industrial. There was an additional comp here, California, 300,000 square foot industrial property in Buena Vista, sold for $71 million. In true California industrial fashion, sales prices per square foot here are a little bit inflated. So you look at sales price here relative to North Carolina, this property comes in at about $236 per square foot. Buchanan Street Partners is who acquired the property, and they bought it from TA Realty. This property, or the portfolio, is located across 5 buildings with addresses ranging from 7050 to 7150 Village Drive. And the assets sold previously in 2016 for $41.1 million. So if you want a green shoot, here it is. That represents an appreciation of more than 70% in just a few years. There's a full write-up on this in The Real Deal. And so, we've talked at some level about comparing property values asset to asset, and we acknowledge that that's, notoriously imprecise, but it can be useful to compare sales of similar properties when they're located in the similar geographic market or submarket. So about 18 months ago, Staley Point Capital acquired a property at 5530 Beach Boulevard and 5609 River Way at the same Buena Park zip code. Those transactions were at $247 a square foot. So, if you don't adjust for size or physical characteristics and you look at just raw price per square foot of 3 industrial comps that are relatively close to each other, this gives you a range of about $235 to about $250 a square foot for this market. So really interesting to see these transactions. And, hopefully for those of you that covet these industrial comps, you get a little satisfaction this week with 2 pretty good industrial comps on disparate sides of the U.S.
So a few programming notes this week before we get to our shout outs. If you're an early listener of the TreppWire podcast, you still have time to sign up for our Market Pulse webinar that is taking place on Friday, October 27th at 1:30 p.m. So you'll get to hear some more from Lonnie and Steven, who will be digging into office maturities, multifamily DSCR, leases. Send me an email if you'd like to get on that registration list. We also have 2 client-only webinars coming up. one for our CRE specific clients and one for CMBS. So if you're interested in signing up for those or finding out how to become a client to get on those lists, send an email to podcast@trepp.com. And then, Stephen, while we have you here today, it's a good chance to plug that you will be in Minnesota in early November, I believe around November 8th, at the Real Estate Journals conference that's happening there. So if anyone's in that area and is attending, make sure you say hi to Stephen. Or if you are in the area and want to attend, send us a note and we'll send you the info to sign up for that event.
I will have lots of good slides and details to share. So if you like the podcast but want to get some visuals in person, that'll be a good chance.
And turning to shout outs, we had a lot of great inbounds this week. Patrick A asked us when we'll be in DC because we've been putting it out there that we have a lot of travelers on the podcast team. I don't know if DC is on our list yet, but we will definitely reach out, Patrick, if we have anyone in town. Our own Matt D said that this is the only podcast he actually listens to, and he even made it a point to go back to the very beginning. He said it's kind of scary to listen to the podcast during COVID when we were saying, oh, we're just home for a week or we'll be back in the office in 3 weeks. So if you want kind of a reality check of what life was like back then, start from the beginning, but don't fault us for the quality of our podcast back then. We had a few people reach out for some of the topics we talked about last week. So Trinidad V was interested in some of our exposure mapping for Rite Aid. So I think someone on our team got back to you, Trinidad. If not, please send us a note. Andrew J requested some of the San Francisco data that we talked about. He said, keep up the great work on the pod. And if we ever need intel on what's happening in the multifamily market there, he'd be happy to be a resource. So we will certainly reach out. John P. listens to the podcast every week and finds it very informative. So we'll be in touch, John, about an opportunity to speak with you in Miami. Anthony H. is a big fan of the pod. He's been listening since the early days. And he said when he bought his first house with a lawn in California, he would think about Manus and the literal sense of the word crabgrass. So we're sorry that our lingo has stuck with you even to when you have to take care of your lawn. And we'll be getting you a t-shirt. Matthew P. posted about our ranking in the Commercial Cafe article, so we were listed as a top podcast there, so thank you to that outlet. And Eric A. said we're a top-tier pod, everyone should listen. Then we had a lot of great feedback. We posted about hitting 1 million listens last week, so thank you to everyone who commented and reached out to us. Brandon B., Mark E., Patrick P., John T., Brendan H., Mike S., and Nicole T.
So I had a couple of shout outs to Haley this week. I've been on the road and interacting with a lot of folks over the last 6 weeks or so, and had a couple of people reach out on LinkedIn as well. So Marina B, she connected on LinkedIn and reached out. She works in risk management in the hotel space and has some interesting thoughts around what's happening in the market. And so I'm going to try to connect with her over the next week or so. Jeff M in Fort Worth attended one of the panels I was presenting at. Larry B, him and I go back a few years. It's great to see him. And then Taylor D, Chris H, Mike S, a lot of people reaching out on LinkedIn, giving some additional congratulations on the 1 million listens. So definitely appreciate it and looking forward to connecting with many more folks as we, get out on the road and go to conferences and have an opportunity to interact with folks in the space.
And then as a little slice of life this week, did you guys see this story about the chance to own a share of Mickey Mantle's boyhood home for $7?
$7. Does that buy you one coat of stain on a 12-inch piece of quarter rounds?
Yeah, it's interesting. I don't know how that's going to work. Like, is this one of those crypto things where it's like, what do they call it? DAU or DAO or something? Decentralized something. Is it a condominium? Do you just get a certain percentage and a common area interest? Not real sure what that looks like, but hey, maybe if you get your name attached to it or you get some sort of certificate of ownership, it'd be kind of cool as an heirloom to pass down that you own part of Mickey Mantle's house. I don't know. Probably passing for me though.
Yeah, it's going to be a lot easier to buy that than his baseball card.
That's true. Yeah, he has some really valuable baseball cards. So we live in an interesting time now. Everything's going to fractional ownership. Go Rangers, Texas Rangers in the World Series. That's what I want to talk about with baseball slice of life. So they've let me down twice in the World Series. They're one of only a handful of teams that have never won the World Series. They made it twice about 8 or 10 years ago, came up short. So I'm really pulling for them this year that they can that they can pull it out.
We'll root for them for you, Lonnie. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.